Are you tired of having a low credit score? Have you tried to improve your credit score and nothing seems to work out? Stick with me on today's video. I will be sharing 7 tips on how to improve your credit score. And 1 or 2 of those tips, you could actually see an improvement in your credit score within 30 to 60 days if implemented. So let's dive in. Hello, hi, welcome to Finance Savvy with IVK. I'm so excited to be here today and talking about how to improve your credit score. You know, 2025, this year is all about leveling up in your finances and setting things right. So we're going to be taking each aspect of personal finance one video at a time to see what we can begin to do to make that aspect of personal finance better. Today, we're going to be talking about credit. And yes, everybody needs credit. Individuals, businesses, corporate organizations, even nations borrow money, right? So let's talk about how you can improve your credit score. First of all, what is a credit score? A credit score is a 3-digit number ranging from 300 to 900 that basically calculate how well you do with credit. So you have a number that tracks how well you pay your bills, how well you manage credit that has been given to you, that you've qualified for, and this number trends upwards or downwards based on different factors. So I'm going to be sharing the factors that actually impact your credit score, and for each one I would give you a tip on what you can do to improve your credit score. So let's dive in. The first one is credit utilization. Credit utilization simply talks about how much of your credit you are using as against the total limit of credit that you have. So let's say, for instance, you have a credit card and the limit on your credit card is $10,000, right? And currently on your credit card, you've used up to $5,000. Simply, calculating that, your credit utilization for that credit card is 50%. So you've used up 50% of the credit that you have on the card, and then you have 50% left. So that's 5,000 used up and 5,000 left on your credit card. And that's the way it's calculated for all the credit accounts that you have. So you have a line of credit, you have student loan, you have a car loan. All these credit accounts are brought together, and they are, your credit utilization is calculated overall for all the accounts that you have. So I would really encourage you to make sure that you are not using too much of your credit. I think typically what is recommended is about 35%. Do not use more than 35% of your overall credit limit. So if you have a line of credit, you have a credit card, ensure you are not using more than 35% of your credit limit. I know some of you are rolling your eyes at me right now that, oh no, that's not possible. I have so many bills to pay. I have this to buy. I have this to buy. Yes, I understand. Life happens, and sometimes you have to make some purchases and you don't have the cash to do that. If for any reason you do go over 35%, which can happen, that's fine. I would just say try and bring it back. Try and bring your credit utilization back to not more than 35%, maybe within 90 days, 3 months maximum, so it doesn't begin to have a larger effect on your credit score. Because the higher your credit utilization, your overall credit utilization on your credit report, the lower your credit score is going to be. Your credit score is going to take a hit for when you are spending more and more and more credit. That's just signaling to the lenders or to the companies, to the credit bureau companies that, hey, you're needing so much credit. That means there's something wrong. This person is not getting a hold of their finances properly. So ensure you are not using more than 35%. If you have to, based on certain needs that arise, yes, do that, but then walk your way back to 35% credit utilization. The next factor is your payment history. Your payment history. Oh, this one is a huge one. Payment history and credit utilization alone contributes about 50, if not more than 50%, to your credit score. Okay, so payment history is the second most important factor that is tracked for how well you're using your credit. So a payment history simply details how often you're making your payment, right? And how on time you're making your payment, right? So making your payments on time, making your payments every month, not missing any payment any month counts to your credit score. It is a huge contributing factor to your credit score. So if you are the type that maybe you miss a payment, or for any reason you are running late on your payments, I would always encourage you, please pick up the phone and talk to your vendor. They may be able to get in a payment arrangement for you that would delay, them reporting to the credit bureau that you are late on your payment. So if for any reason you are going to be late on the payment, reach out to the lenders, let them know, work out something, and ensure you make your payments on time. Another thing to point out here is also ensuring that you are making your minimum payments, right? So make sure that you are making at least your minimum payments, nothing below that. You can't make anything below that. And of course, you can see what your minimum payment is from your statement. So you would see your payment due date, which is the date that you have to make the payment before that date, so that it doesn't affect your credit score negatively. And then your minimum payment that you have to make to keep your account in active status. One more thing to note about payment date: if for any reason your payment date, it's that time of the month when you don't really have money and this contributes to you missing your payment, pick up the phone again and work out something with your lender. Tell them when you have money, maybe just after you get a paycheck or after your whatever it is. Let them know when you have money and they can reschedule your payment date. And that way you can be sure that you're making your payments on time, you're not missing your payments, and then you're also making nothing less than the minimum payments. And also you can also set up your minimum payments on auto debit on your banking app, to make sure that 2 days, 3 days, or even 1 week before my payment due date, if I have the money, this money goes to my credit card, it goes to my line of credit, and I don't miss any payments. And that is one of the ways to ensure that, your credit score is high up there and is intact. So to improve your credit score today, look at your credit report and see what payment can I begin to make on time that would help me get back on track with my credit score. And I tell you, this is one of the key factors that if you start making your payment on time today, if you make 2 consecutive payments on time, you would see an upward trend in your credit score. So, after this video, pick up your credit report, review it, see how you can begin to make your payments on time regularly, and you would see an upward trend in your credit score. The third factor that really impacts your credit score is your credit history or your credit age. Credit history plays a huge role in how your credit score has been calculated. And what happens is that they look at the very first credit account you have. So that could be a credit card, or maybe most likely a credit card or a student loan, whatever it is, that the average of all your credit accounts are calculated. And the longer it is, the more points that is going to count towards your credit score. So I always encourage people, the tip here is that if you have an account that is one of your oldest accounts and it's active, it's fine, it's paid off, do not close that account. If you close that account, it may impact your credit score negatively, because by the time they calculate an average of what your credit age is from the very first credit account that you opened to the most recent credit account that you opened, that one falls off, and it's going to impact what will be calculated as your credit age. So please keep your oldest accounts open. Don't close them. If it's a credit card or if it's paid off, just leave it. Most times, if it's paid off, if it's a line of credit that is paid off or a car loan, it's going to fall off your account. And yes, you may lose some points, but then you're going to regain it as you go on. But typically, your credit card, your line of credit, make sure that those are left active, right? And make sure you don't close it. Don't do that, because if you do, it's going to impact your credit score negatively. So what I would say is maintain them and just leave it on your credit, as it adds more points to your credit when the credit history or the credit age of your account is calculated. The next one is public records. And this is basically, you want to check your account, your credit account, for any negative comment that you have on that account and see what you can do about it. So public records are really any record that has to do with your financial history, obtained from the government or from public sources, that is put on your credit report, and it usually stays there for as long as 7 years. Guys, this is one that I always encourage people to try and avoid if they can. And an example of this is collection. So you have a bill, you did not pay the bill, and you've been getting calls, oh, pay your bill, pay your bill. And for some reason, life happens, right? And then you forgot to pay the bill, or somehow you couldn't pay the bill, and then it goes to collections and it comes on your credit report, and your credit score takes a hit. It will definitely take a hit, and your credit score drops. So what are you going to do? Well, the first thing I would say is, number one, try and see how you can resolve that on your account. Some you may be able to resolve, some you may not. So for instance, if someone has filed for bankruptcy, that would also stay on their credit report for about 7 years. And the truth is, the impact is going to be on the credit report until it falls off, or that record gets wiped off from the credit report after 7 years. So really, really, really ensure that you are keeping track of your bills. Ensure that you are making payment arrangements. If you can't make a payment and the bill is coming due or it's late, please call and make a payment arrangement with the company. Most times, if you do this, it won't go to collections. It's when you neglect the bill and you don't call, you don't pay attention to it, you don't have a payment arrangement in place, nothing. After some time, you just be like, no, this should go to collections, and then it's going to impact your credit. And then you get a call for collections and you start thinking of how to solve it. So let's try and make sure things don't go to collections, right? Whatever you can avoid from going to collections, let's try and stop that. So be on top of your bills, right? Automate as many of your bills as you can. If for any reason you can't pay, call the lender or the company and then put a payment arrangement in place to ensure that your bills are paid, and it doesn't go to collections, or you don't have any negative remarks or derogatory remarks on your credit report. Okay, another point I would like to talk about is checking your credit report at least, at the minimum, twice a year. I want to say once a year, but 6 months apart, that's a lot. Check your credit report at least twice a year. And when you do this, what you are looking out for is, number one, you're looking out for any fraudulent activity on your credit report, right? So you want to make sure that there's no impersonation going on, no one is getting a loan that you don't know about on your account, on your name, and it's something that comes on your credit report and you can't pay for it, right? And then before you know it goes to collections. So make sure you are getting your credit report. Another factor that contributes to your credit score is the number of inquiries within a specific period on your credit account. Whenever you put in an application for, let's say, a credit card or car loan or whatever kind of credit it is you want, a personal loan, and the lender evaluates your credit application by pulling your credit score and your credit report, your credit score would usually get a hard inquiry, and that would take some points off your credit score. And this hard inquiry goes onto your credit report to say, on XYZ date, you try to access credit from this organization or from this lender. So the tip here is that if you don't really, really need credit, don't apply for it, because it's going to lower your credit score and that's going to bring down your credit score. So you want to make sure that you really, really need that credit for you to apply for it. So hard inquiries would hit your account when you initiate the request for credit. Soft inquiries, on the other hand, because there are two kinds of inquiries, soft and hard. Soft inquiries, on the other hand, it does not go on your credit and it doesn't impact your credit score in any way. Soft inquiries are used by lenders when basically they're trying to do promotions or pre-approvals, things like that. They have promotional offers and pre-approvals, and they say, oh, we just want to check your credit. It's not a hard hit. It won't impact your credit score. They just want to see, a snapshot of your credit score and your credit report, and that doesn't get onto your credit score and it doesn't impact your credit report. So the soft inquiry, that's fine, but a hard inquiry, that stays on your credit report also for 2 years as well. So limit the amount of times you are requesting for credit. If it's too much, you're going to get hit. Your credit score is going to get hit, and that would impact your credit score. So we want to make sure that you're limiting that. You're not doing that too often. Do it only when you really, really need to get credit. And in addition to that, you can also see if you can get a pre-approval or a pre-qualification. A lot of organizations have that these days where you can pre-approve, and from there you would actually know whether you would qualify for that credit, if you put in the application or not. So before you go the hard inquiry way, try to see if you can get a pre-qualification or a pre-approval in place. That would then give you an idea if you would qualify for the credit. It's not 100% guarantee, but it just lets you know if you could qualify for the credit. And then you could also, check your credit score on Equifax or TransUnion before you go ahead to apply for credit that you really need, just so that you are informed and you have an idea of what your credit score is before you put in that application. Yeah. So tip number 6. Tip number 6 is checking your credit report frequently. I would recommend at least twice a year. Checking your credit report is not one of the factors used in calculating your credit report, but it does give you some additional insight aside your credit score into what is going on with your credit account. So when you check your credit report, when you request for your credit report and you do a check, what you're watching out for is you're watching out for fraudulent transactions, making sure no one has collected a loan or a credit card in your name and you didn't know about it. You're checking the amounts. If you applied for a loan, you're checking the amounts to make sure it's what you requested for. It's not higher than what you requested for, because that means then you definitely have to pay more. You're checking out for anything that has to do with identity theft on your account, right? Just to make sure that it's not going on, because that can be very, very messy to deal with. So make sure that twice a year, maybe at the beginning of the year and maybe in the middle of the year, you request for your credit report, and you can have a better insight into what goes into calculating your credit score, and also see how your credit accounts are doing. And you can have some more detail into what you have in your credit report. I know that each of the credit reporting agencies give you one free statement per annum, right? So you are entitled to one free credit report statement once a year. I think if it's more than that, then you have to pay for that, but you can get at least one statement free of charge per year, and you can review your accounts and review your credit report. And the last tip, the 7th tip, last and not the least, is to check your credit card statements. Oh my, this is so important, because some of us, we just once we make our minimum payments, or you just, oh, okay, I spent whatever amount this month, and then you pay off your credit card. Most of us don't take time to actually pick up a credit report, maybe 1-2 minutes, scan through the transactions to make sure all the transactions there are valid. Sometimes you have transactions in there that you did not pay for. Maybe someone stole your credit card and they used it, or whatever it is. So make sure you are checking through. It won't take you more than 2 minutes. Check through your credit report, your credit card report every month, to make sure that all the transactions there are valid, you know about them, there's nothing funny going on in there, just to make sure that things are going on fine with your credit report and ultimately your credit score. So these are the 7 tips. So it's been a great time sharing these 7 tips with you today. Subscribe and like, and I'll see you in the next video.